Today I'm going to talk about how the essence of business financing is the proper management of risk.
If you're a small or medium-sized business owner, then you are both business person and business investor. The process of starting a business and growing it must have a considerable and continual focus on risk management for a number of reasons. First, without eliminating, identifying, and mitigating risk, you always put yourself in a position to be shut down by events you no longer can control or influence. Second, your ability to track capital and lower cost forms of capital is highly dependent on your ability to show that you have historically been able to manage risk and that you have accurately identified and mitigated existing risks to a satisfactory level. Third, you put your own hard-earned equity in jeopardy, which can set you back years and create a level of stress and disruption that most people would want to avoid at all costs. I came across this article for managing risk in the Financial Post titled, "No Need to Dread Investment Risk, Just Manage It," which was all about properly identifying risk and then managing it accordingly, which made a great deal of sense to me. It's interesting that when I talk to entrepreneurs trying to raise capital, the attitude many times is that you have to take risks, and that just comes with the territory. Their focus is to aggressively market their opportunity, taking the position that the strong upside will more than make up for any and all risks they face as a new business or an existing business taking a leap into a new area of business opportunity. But regardless of the potential long-term upside, in the short term, the risk you're taking can kill the business. Which is also why startups and acquisitions have such a high failure rate and why they have such a hard time attracting capital. Sources of business financing, either in the form of debt, equity, or a combination of the two, are certainly looking for opportunities to extend loans or make investments, but what they're also looking for is a business model and opportunity that has done a good job of identifying the risks that further capital investment will bring, along with a plan to address and mitigate these risks in an acceptable fashion. There is always going to be a risk of loss for everyone involved, but having an approach that demonstrates risk management has a much better chance of raising capital than one that does not. Let me further add to this last point. The less focused you are on risk and risk management, the harder it will be to locate and secure capital. The more likely the cost of financing will be higher, the more likely that the terms and conditions of business financing will be more difficult to meet and manage, and the collective result of the above is that the risk of failure has also increased. During good economic times, when there is an abundance of money that needs to be placed by money managers, the prospects for getting money for the aggressive business owner or entrepreneur could still be very strong. But right now, we are not in such times, and the more sure path to money is by demonstrating your ability to manage capital and keep it. And as the article I referred to earlier states, if it keeps you awake at night, it's too risky. This line of thinking should always be factored in before you accept any type of business financing commitment.
So if you have a business financing problem, challenge, or requirement that you need help trying to solve, then I suggest you give me a call or send me a note to the contact information at the end of this video. And I wish you all the best in your business financing endeavors. Take care.